Sadiq Hussain is here. He is the Senior Executive Officer of Seviora. It's a wholly owned subsidiary of Singapore's Temasek, and it is marking the launch of a brand new Abu Dhabi office right here in ADGM. He joins me around the desk. Sadiq, welcome to the program. It's great to see you.
Hey, thank you, Dan, and really exciting time. So good to be here. Thank you.
Indeed, really exciting time for Seviora, also a really exciting time in the market. So let's start with the announcement first. Why Abu Dhabi? Why now?
Yeah. Very briefly, Seviora was established in 2020. We are wholly owned by Temasek. Our assets under management today are around $54 billion. Geographically, we are currently, our headquarters are, of course, in Singapore, followed by India, China, Indonesia, and now Abu Dhabi. We are around over 200 investment professionals in these geographies, representing 5 distinct asset management companies. And our product offerings and solutions are primarily in private credit, private equity, venture debt, public equities, and also some Asian fixed income. So we dabble in both the alternative space and also in the liquid and semi-liquid space. ADGM, as Dan, you must have heard many times, has been Abu Dhabi has been called the capital of capital, and for very good reasons. We are delighted to be here. It's an ecosystem that is growing extremely rapidly, and it is also, well, we are home to $1.7 trillion of assets under management by the sovereigns here. The regulator is extremely progressive and forward-looking. It's got English common law. It's got all the bells and whistles that a financial institution should have. So truly great to be here and excited.
So let's walk through the broader strategy, because it's an increasingly crowded space as well. Lots of people selling Asia, Middle East diversification at the moment. So what's your secret sauce?
Well, our secret sauce, first of all, our strategy that we talk about today is, which we think is relevant with this volatility that's happening around us, is Asian private credit. And because of our long history of being in the region, having these global footprints that we have, the linkage with Temasek, and of course in the private credit space, knowing the corporates that we lend to with strong balance sheets and strong covenants, is something that's one of our secret sauce, that we really know the clients that we're talking to and lending to, and these are the SMEs and also the startups. So in the startups, there's the venture debt space that we're in, and in the private credit space is to the SMEs primarily.
You also have a partnership with Mubadala Capital. So are you going to be launching regionally domiciled funds or products from the UAE as a result of this new launch?
Yeah. First of all, we signed that MOU in October of last year. This is a significant milestone for us, and it's been an ongoing relationship which has been inked now last year. So this creates a platform for mutually beneficial partnership and co-investment opportunities in both in Asia and globally.
Walk me through what we're seeing in the markets right now as well. Obviously, a lot of volatility over the last week. So what do you make of Trump's most recent tariff turnaround, this timeout on tariffs? Smart move?
I wouldn't comment on the tariffs currently, but I would mention the fact that Asia private credit is, the impact on that would be, we believe, should be muted, because of the fact that it's very insulated. The lending that we're doing to local companies is very domesticated, and to local balance sheets, which are very strong, and the covenants are very strong around them. The exposure that they have, the corporates, to the U.S. tariffs is limited. So to be in that space as a diversification play is what we are talking about, especially in these times.
You don't think Asian private credit markets are going to see a spike in defaults as a result of the backdrop that we have unfolding right now?
So there will be an impact, but we think it's going to be a muted impact.
Muted?
Yeah, meaning it should be, it's not going to be heavily impacted because of the fact of the domestic nature of the loans. that we're providing in the private credit space.
How else are you taking advantage of this moment as well? Because we're seeing Asia credit default swaps tightening the most in around 6 months. It's risk on out there at the moment. So what's the broader strategy here? Because there's a lot of dislocation. Are you leaning into this volatility, taking advantage of that, or are you de-risking broadly right now?
So in the U.S., the credit spreads are tightening, as you know. But in Asia, we've seen that there's still 200 to 500 basis points as a gap that you can actually achieve on shifting that strategy and from a diversification play. So that is why we keep talking about Asian private credit, to see that if you can get better yields and tenures in Asia.
Is China still investable under the weight of a 125% tariff, or are we past the point of no return here?
We are closely watching what's happening in China. We have an on-ground presence there, and opportunities are definitely out there in China. And I think this is the time when in high times of volatility, if you've known before, traditionally you go to the U.S. as a market. But since the issues and everything else is being stemmed from that market today, people are looking outwards, and this is going to have a very big focus on China. So we are watching all the sectors within China and seeing where the opportunity lies.